Hello everyone, this is Tsering and Anton. We are presenting Crocs for Town Project Part 3. To give a brief introduction of the company, Crocs is one of the world's largest footwear companies and it operates in the global casual footwear market. It operates 340 stores in more than 85 countries and it employs over 6,600 employees globally. Today, we will go over our forecasting assumptions, present forecasted financial statements, discuss future path and competition for Crocs, and also discuss risk factors.
We'll start with the general assumptions. There is no doubt that attraction to Crocs brand was accelerated during COVID pandemic when people were replacing their boring formal shoes with more comfortable casual footwear. And Crocs demonstrated a phenomenal growth since 2020. Revenues grew 67% in 2021 and another 54% in 2022. If you look at the chart on the right side, there is a comparison of cumulative total return on investment taken from the latest 10K. Green line represents Crocs. The questions that we asked ourselves: would pandemic effect wear out as rapidly as it started? Or the company will be able to sustain current results and even grow? So we are convinced that this is not a temporary effect of the pandemic, but rather a structural change. The company continued rapid growth in 2023 based on the latest 10Q results. It acquired Hey Dude, an Italian casual footwear company in 2022, and it grew its balance sheet from 1.1 billion to 4.5 billion in just 2 years. Last year revenues were 3.6 billion. We expect to see revenues surpass 4 billion mark in 2023 and 5 billion mark in 2025. In our opinion, short and near-term growth will be fueled by new products, international expansion, collaboration with designers, and promotion of Hey Dude brand. Our short-term assumptions are mostly based on the company's historical results and the latest 10Q filing. In this presentation, we'll focus on a few areas which we consider the most important in our forecast: revenues, cost of goods sold, and operating expenses. Starting with the revenues, on this slide, we compare Crocs revenues to its closest competitors. We purposely removed revenue that belongs to Hey Dude from the charts to demonstrate the organic growth of the core brand. So on the left chart, you can see that Crocs significantly outperforms the competition in terms of revenue growth. On the right chart, you can notice, unlike competition that experienced decrease in revenues, Crocs actually gained almost 13% in revenues in 2020. It's evident that Crocs is going through a significant growth phase as industry trends shifted to more comfortable casual footwear. We believe that company still has a growth potential for the next 3 to 5 years. We decided not to rely on competitors' results to forecast short-term revenues. However, long-term forecast will be closely aligned with the industry average. On this slide, you can see actual and projected revenues by region. Overall, there is a continuous growth in the next 6 years, with the first projected year showing solid 13% growth, in the year 6 showing more of an industry average 7%. The company identified Asia as a region with a rapid growth potential, and at 2022 revenues from Asia represented around 13% of total revenues, while we estimate that by year 6 the share will grow to around 23%. There are, of course, different ways for forecasting revenues, and we could have used the company's historical results or industry average. However, that was very challenging because they were not very representative due to abnormally high growth in the previous 2 years. So we used more of a blended uh, method approach here.
Thank you. Cost of sales for Crocs includes expense incurred to design, produce, procure, and ship the products. Crocs' cost of sales increased from 506 million in 2017 to over 1.6 billion in 2022. Cost sales as percent of sales was about the same from 2017 to 2022, which is about 49.5% in 2017 to 47.7% in 2022. When we compared other competitors' um, data to Crocs' cost of sales to revenue data, we found that Crocs' cost of sales to revenue is less than the competitors. As we did not have fixed and variable cost information, we looked at Crocs' cost of sales as percentage of sales for the 5 years, which showed that cost of sales was between 38.6% and 49.5%. So the change in cost of sales goes at the same rate. So we took the average cost of sales as percentage of sales for the last 5 years to forecast the year +1 to +6.
We'll continue with selling, general, and administrative expenses. SG&A was improving every year, and you can look at both charts. So in 2017, it was around 48% of revenues, and in 2022, it was around 28% of the revenues. So this improvement was due to strong sales growth and continued efforts to leverage operating costs. We utilize different methods in our forecasting because it better accounts for that rapid growth in the last 2 years. Our forecast for years 1 and 2, we analyze the growth in revenues and corresponding growth in SG&A. We found that for every $1 growth in revenues, the company incurred around 64 cents in additional expenses in 2021 and 68 cents in the year 2022. So we assume that for the next 2 years, $1 growth in revenues would add around 76 cents in year 1 and 88 cents in year 2. For the following years, we expect SG&A expenses to rise as a percentage to revenues to accommodate higher volumes. And for year 6 and forward, they'll be in line with the industry average, in our opinion.
Here is a projection of our income statement for Crocs for their next 6 years. So here for our projection, we did not calculate or use asset impairment in our projection because according to the most recent 10K, Crocs evaluates their impairment of long-lived assets when a significant event occurs, indicating there is a potential impairment. So that is why we decided not to include the asset impairment in our forecasting. For interest income, we used interest income as a percentage of cash and cash equivalent based on the prior period data. According to our prediction, Crocs net income increased from year +1 to year +5, which is from 675 million to 944 million, and then decreased in year plus 6 to 895 million.
Here we present a projected balance sheet for the company for the next 6 years. As you can see, total assets grew from $4.5 billion to $7.3 billion in year 6. All these accounts grow gradually with the growth in revenues. However, some of them, if you can look at property and equipment, there's a significant change in year 1. There's an increase to accommodate higher volumes. There's another increase in year 1 for right of use assets. These relate to leases. The company plans to start using newly built distribution center for Hey Dude brand in Nevada in third quarter of this year. Here you can see a continuation of the balance sheet, liabilities and equity. If you notice, total liabilities went down from $3.7 billion in 2022 to just under $3 billion in our forecast for year 6. And this is largely due to repayment of the term loan which the company took out to finance the acquisition of Hey Dude. So in 2022, it took $2 billion. Since then, it had been aggressively repaying the loan. So in 2022, it repaid $325 million of that loan and another $495 million during the first half of 2023. So we think that the company will be able to pay remaining loan balance in less than 4 years. We also expect the company to issue some common shares in 2023 to help out with repayment of the loan. And going forward, we expect the company to buy back some of its shares, as indicated here, treasury stock.
Future path and competition. Crocs has a distinct product offering with its signature clog style shoes, known for their comfort and versatility. The company's success is built on the uniqueness of its design, which can set it apart from the competitors with more traditional or generic offerings. Croc has established strong brand recognition and its logo is instantly recognizable. Competitors may struggle to achieve the same level of brand awareness, and Crocs can leverage this to maintain market share and customer loyalty. Crocs has a history of innovation, introducing new styles and materials for its shoes. Its ability to continue innovating and responding to changing consumer preferences can differentiate it from competitors. Crocs has expanded its product portfolio beyond the iconic clogs, offering various shoe styles, accessories, and collaborations. This diversity can help the company tap into different market segments, unlike their competitors.
And lastly, we wanted to discuss some industry-wide and economy-wide factors that could significantly affect our forecast. Starting with the industry-wide, we listed manufacturer concentration. As you may know, many companies in the footwear industry produce their products overseas, mainly in Vietnam and China. Changes in regulations in those countries could significantly affect the forecast for Crocs. Many companies in this industry rely on long-distance shipping. This is another risk factor. For economy-wide factors, we listed global recession, surge in oil prices, another pandemic. All these are risk factors that will significantly impact the forecast for Crocs.